Welcome to this explainer. Okay, the accounting industry just witnessed what is easily its biggest shakeup in decades. Grant Thornton Advisors is officially acquiring CBIZ, creating an absolute titan of professional services here in the US. If you follow corporate strategy even a little bit, this is a story you literally cannot ignore. We're going to break down exactly why this deal matters so much for businesses, employees, and of course, investors. To really grasp the sheer gravity of this, just look at this number. $3 billion. And actually, let me clarify, this isn't some complex stock swap. We are talking about a nearly $3 billion all-cash deal. In the typically, more conservative world of accounting, dropping that kind of cash sends massive shockwaves through the entire market. It is a very definitive statement of intent. Okay, let's dive right into how this breaks down, because the details here are absolutely fascinating. The agreement gives CBIZ shareholders $55 per share, which is a really significant premium over where they were previously trading. But that $3 billion purchase price, that's really just the beginning. When you start factoring in debt and other financial obligations, the combined enterprise value of these two giants pushes to a staggering $5 billion. Assuming this gets all the shareholder and regulatory green lights, we are looking at a brand new powerhouse in American accounting, tax, and advisory services. So here's our quick roadmap for today. First up, we'll look at the epicenter of the deal, then the strategy behind the merger. Number 3, we'll cover the human impact. 4, the broader ripples across the industry. And finally, number 5, we'll wrap up with the investor watch list. All right, Section 1, the epicenter. This is a historic accounting consolidation. The core philosophy driving this is really all about buying time. By snapping up CBIZ, Grant Thornton instantly expands its national footprint. They are immediately adding thousands of seasoned pros to their roster and getting access to a massively expanded client base. In the hyper-competitive professional services world, trying to build that kind of robust nationwide growth organically, that would take years, decades maybe. Instead, they're choosing to accelerate their growth instantly through this one massive acquisition. Now, let's look at Section 2, the strategy behind the merger and how they are adapting to new client demands. Now, what's really interesting about this is how much client expectations have completely transformed. Clients want so much more today than just traditional tax planning and payroll. There is a massive market-wide surge in demand for digital transformation, AI consulting, really rigorous cybersecurity, and strategic wealth management. Grant Thornton knew they needed to scale up rapidly so they could actually offer all of this comprehensive support under one single roof. And that brings us to exactly what CBIZ brings to the table. They're already one of America's leading providers when it comes to accounting, tax services, payroll, employee benefits, insurance, and financial consulting. What makes them such a uniquely attractive target is their nationwide presence and those deeply rooted client relationships. They successfully handle everyone from tiny local firms all the way up to massive corporations. By absorbing these core offerings, Grant Thornton instantly supercharges its competitive position. Okay, moving to Section 3, the human impact. We're looking at clients, employees, and the reality of integration. Let's start with the existing clients. For businesses that are already working with either of these firms, this merger is essentially designed to unlock a much broader menu of services. Clients are going to benefit from expanded advisory expertise, way more cutting-edge technology solutions, better international capabilities for their global operations, and much larger, highly specialized industry-specific teams. The ultimate goal here is to build a seamless, one-stop shop for basically any challenge a business might face. So the crucial point is, integrating two massive organizations is never just a simple plug-and-play situation. Think about it. Merging totally different IT systems and tens of thousands of staff members, it's kind of like trying to swap out the engine on a commercial jet while it's still in the air. The friction of integration is entirely real. Maintaining top-tier service quality while they untangle and combine all these complex daily operations is going to require some serious, meticulous management to make sure clients don't feel every bump in the road. We also have to take a neutral look at what this actually means for the workforce. This newly combined entity is going to employ tens of thousands of professionals across the U.S. On one hand, leadership is heavily emphasizing that this is all about growth and expansion, which, usually creates exciting new career opportunities and pathways for advancement. But on the flip side, the reality of literally any major corporate consolidation is organizational restructuring. As they merge, there will inevitably be scrutiny on duplicate roles across departments. This whole integration process is definitely something that employees and industry watchers are going to be monitoring very closely. All right, Section 4, ripples across the industry. Let's take the macro view. the biggest accounting sector takeover in a generation. I love this quote from analysts because it perfectly underscores just how historic this deal is. This isn't just your routine corporate acquisition to add to the record books. It sets a completely new baseline for what scale actually looks like in this sector today. Because look at the exact growth areas driving this industry-wide consolidation. If you want to fiercely compete in artificial intelligence, cloud tech, cybersecurity, and complex strategic consulting, larger firms are realizing they literally have to buy, not build. Trying to spin up these tech-heavy practices from scratch is just way too slow right now. This merger could easily act as a massive catalyst, basically forcing other major firms into similar blockbuster deals in the coming years just to keep pace. Let's move to Section 5 and see how this builds into our investor watch list. What actually comes next? Well, if you're keeping a close eye on the markets, here's your definitive checklist of factors to monitor. First up, obviously, is securing those regulatory and shareholder approvals. But once the ink dries, watch the integration progress. Are they actually hitting their projected cost savings? Are they driving new revenue growth? And probably the most critical one, are clients staying? If they can check all these boxes, this combined company is going to be a terrifyingly fierce competitor in the market. So, to summarize everything we've unpacked today, the accounting industry has definitively entered a new era. Grant Thornton is actively building a larger, significantly more diversified firm that is custom-built for a complex, tech-driven marketplace. But remember, the ultimate success of this $5 billion enterprise will hinge entirely on how smoothly they can actually combine their operations, their talent, and those vital client relationships. So what does this all mean? I want to leave you with this final thought to consider. Looking at the massive scale of this consolidation, the pressure of these new tech-driven demands, and the inevitable friction of merging tens of thousands of people, do you think this merger will fundamentally reshape the accounting industry for the better? Or will it just create a whole host of new operational headaches for both firms? It is going to be absolutely fascinating to watch unfold. Thanks so much for joining me for this explainer, and keep learning.